it's Michelle. So today is part 2 of our series on refinancing your mortgage, and we're going to talk about how your credit could affect your ability to qualify. So whether you're refinancing or purchasing a home or even getting a job, it's important to know how your credit works, your scores, etc. So we're going to talk about all that today. I am Michelle Fernandez, and I'm all about helping you balance it all while putting your fresh face forward. And today I'm here with Deborah Reyes, who is South Florida's best mortgage lender of the year, aka my mom, Deborah Reyes.
Hello.
So we're going to be talking, like I said, about your credit and how it affects. So let's start with something simple. So when we hear about these credit scores, like what do the credit scores mean? Who makes up the credit scores?
Good question. Credit scores are made up through formulas of 3 different repositories: TransUnion, Equifax, and Experian. Each of those repositories have their own formula of how to score your credit. The things that make up those scores or in the formula, the variables are, or some of them, are how many inquiries have you had in the last 90 or 120 days. Inquiries mean how many people have checked your credit in order to lend you credit. The second might be the balances to what your high credit limit is. So let's say you have a credit card that you can have $1,000 to loan on it, and you've borrowed $900. So that would be a very high ratio to a relationship to the credit. The other one would be, do you have any collections, any outstanding judgments? Have you had a bankruptcy? Those are just a few things that might affect your credit score.
Okay, so when we hear somebody talk about, let's say, their FICO score, that is just one score.
Correct.
Right? So that would be from one repository.
Correct.
So explain to me why there would be 3 repositories and 3 different scores.
Because the trades, MasterCard, American Express, Macy's, JCPenney's, they don't all report to each of the repositories. Some do. Some only report to 1. Some report to 2. So when we're doing an inquiry or checking your credit for a mortgage, we want to find out from all 3 repositories what the different trades are reporting and what those scores are, again, since not everybody reports to the same one or all 3.
So that makes sense. So that's why it's what they refer to as a merged credit report or a tri-merge. So they take all 3 repositories. So that's great, because then let's say you have good credit with somebody where you're making your payments on time. If somebody only reported or pulled 1 score, then it wouldn't really get that good credit that you're maintaining.
Correct.
Right? Okay, good. So you talked about inquiries. So how do those affect you negatively when you see inquiries, and how long back do they look at your inquiries?
Well, inquiries usually stay on your credit report for about 120 days. Most of the time I see it for 120. We're looking probably immediately more like 90. And how does it impact your score? What it's saying is that you have solicited credit in order to borrow monies, and that could negatively impact your credit score because now you're accruing more debt. And if you have more debt, then there's more repayment. So then you're not as much of a credit risk. But it's not exactly that, but that gives you an idea of how a credit inquiry could help or hurt.
Okay, so just to clarify, a credit inquiry is when somebody else is pulling your report. So like if you apply for a credit card or a car loan or something, even if it's for your new phone or FP&L or something like that, utilities, that would be an inquiry.
That's correct.
Right, so they're looking at what maybe additional debt you're looking to incur. Okay, so let's talk about, you mentioned your balance, let's say on a credit card, your balance to your high limit. So let's say I have a credit card that has a high limit of $3,000, meaning I could charge as much as $3,000, but I either have a balance of $1,000 or maybe even a balance of 0. So if I have a 0 balance, how does that affect saying, okay, I don't even charge on the card? Does that positively or negatively affect my credit?
The fact that you have credit limits and you have zero, that's a good sign because you're not a high credit user and so your risk is lower. But if you never use the credit card, then there's nothing for the formula to measure or the formula to factor in with those variables. So my recommendation is if you're the kind of person who doesn't like to have any balances on their credit, maybe you use the credit card to buy gas. When the card comes in, you pay it off. Go out for dinner, you use the credit card. When the card comes in, you pay it off. But you should rotate and use a few of your credit cards like that, especially if you're the type of consumer who doesn't like to have any balances at all. So we want to give them something to measure your credit.
Right. So we want to create that payment history,
Correct.
basically, because if not, then your score could be zero or not reported. Like what happens if you don't have any credit?
Well, if you don't have any credit, people go, oh, is that good or bad? Well, if you're trying to get a mortgage, then we want to have at least one. In some cases, some investors or some lenders want you to have at least two credit cards. And they want to show a history, some of 12 months, some of 24 months. Every lender has a different guideline. And so they want to demonstrate your willingness to repay the loan. And the only way we can demonstrate the willingness to repay the loan is by showing a credit history where, in fact, you have reflected the use of that credit for the last 12 or 24 months.
Okay, so now we're talking about all good payment history. So let's say, we all go through bad times. None of us are perfect, whether it's an illness, a loss of employment, something like that, or maybe we fell into negative credit where we missed a payment or two. How does that adversely or affect our credit? Like, how long should we wait to apply? Like, how does all that come into play?
Well, what we want to do is definitely identify what the issues were. We need to do our best to correct them within the system. If you had a problem just in a particular window of time, maybe you've now straightened the credit out, you might be able to go back to that creditor and say, I've had a credit card with you for 10 years. For 6 months, I had a real problem, but for the last year, I'm back on track. Is there a possibility that you can remove that derogatory credit from the repository so that I can start to do my credit and increase my credit scores? That's one way. Another way is for you to then continue to make payments accurately, try to get new credit that will establish new credit so that you can pay everything timely. And so you want to work on the repair.
Okay, so let's say that we have a mortgage, a late mortgage, and I know that's like mortal sin of mortgage financing, but what do we do if we did fall behind on a mortgage? Or maybe we even had a foreclosure or a short sale? Because remember, we talked yesterday about, it's been about 10 years almost already, right? 2007, 2008 area where the housing market crashed, and then slowly thereafter, people were under on their mortgage, so they either had to do a short sale. Some people, unfortunately, went into foreclosure. So maybe now that it's a few years later, they're looking to reestablish or purchase a new home, or maybe they owned another property that they want to refinance. Like, is there a certain wait time that they have to wait for that? Or
Yes, there are what we call waiting periods. And the waiting periods are different for conventional loans, that's like a Fannie Mae loan, to an FHA loan or a VA loan. And the waiting periods are different time periods. For foreclosure is the longest period. And then for deed in lieu, where you turned your keys back in, the short sale, or a modification where you've now started to correct your credit and making your payments accurately. So you want to check with your lender to check what their waiting periods are, and the waiting periods, depending on if it was any of those things or even a bankruptcy, the waiting period can be anywhere from 2 to 7 years, depending on which one of those things that you fell into. And the other issue is how much money you're going to be putting down. So the waiting period might be a shorter waiting period if you're putting 20% or 25% down as opposed to wanting to put 5 or 10% down.
Well, that makes sense. So the good news is that there's hope
Yes.
for those people that may have had a foreclosure or a short sale, the key is, what it sounds like to me, is to have a plan. Like, I know I always talk about that, like, have a plan, have a goal, like, okay, find out what it is, see where you are. It sounds like even the same thing if you had late payments on credit cards or maybe an auto loan or something like that, you need to give it a little bit of time to cure, because I'm assuming that when you pull the credit scores, it also counts time. So time cures all. So maybe you can't refinance right now, but maybe in a month or 3 months, you know, if the market is right, you can look into doing that as well as to purchase a home.
That's true. I like your idea about the plan, because that's what I talk about with our clients. So you might want to start first with your mortgage lender or your bank and ask what the issues are and what I need to do to correct it. And then the second step would be either you do it by yourself with your different creditors, but there are also some not-for-profit credit counseling agencies that help you with that process. There may be fees affiliated with it, but you want to start with your lender. What do they need? And then you work backwards into that plan, because getting a mortgage and what they need might be different than getting a car and what that trade would need.
That's true. Now, you mentioned about credit counseling agencies. If you decide to go to one, or before you decide, I should say, to go to one to maybe debt consolidate and make a payment, is that looked positively or negatively by an underwriter for, let's say, a regular conventional loan, which would be like Fannie Mae, Freddie Mac underwriter?
Well, it's interesting that you asked that question, because it's not a black and white answer. Every lending institution has their own guidelines. There are some people who feel like, oh, they couldn't do it on their own, so they had to go somewhere to get it fixed. And then there are others that feel like, oh, okay, well, they got help, and now we have to factor in this payment monthly into their recurring obligation. So, like I said, I think I would work with my lender first, ask them to help you with the plan and what direction you should take. And then once you've reached that, what will they look at? Will they look at that payment plan you made with the counseling as a positive or a negative? So again, working backwards.
Okay, and then I have one last question, maybe, because as she's talking, it's making me think of new things. Okay, so every morning while I'm getting ready, I do have a TV in my bathroom. So I do watch sometimes the news, sometimes a show, just to kind of, have no thoughts in my brain. But the commercials come on free credit score. I want to buy a car, I want to buy a house, like I want to rent an apartment. So when you see those free credit score things, like with that credit score, that is a result of maybe what you would be looking for in mortgage lending.
Well, the free credit scores and getting those, sometimes they're also offered through your credit cards, etc. It is a good thing, because it kind of gives you a pulse on what your credit looks like. But I wouldn't bank on it being exactly the score as that you would get when somebody pulled your credit for a car, or when somebody pulled your credit for a mortgage. But it does give you an idea. The credit report will show what everybody is reporting, whether you're no times 30 days late or you 1 times 90 days late in November 2008. So that history you'll see, and that's a good way to start with your analysis and putting your plan together.
Right, because I don't think, unless you pay extra, will that include all three. Because remember, the goal for mortgages is of the merge of all 3 reports. So that's good to know. So right. Then, just to kind of recap on the credit side, is you want to have a plan. You want to know what that history is, or if when you approach your mortgage lender and they're interviewing you while taking the application, you want to make sure if you've had some issues, whether it be last month or 10 years ago or what have you, you want to tell them, hey, look, I went through a bad time. I lost my job. I had these issues. I don't know if it'll affect my report, but just to kind of give them a heads up. Or, hey, 3 months ago, I had this problem, and let's make a plan, because I really want to buy a house. I really want to look to refinance. So I want to make sure that I get the best rate as possible, because I am assuming that the lower your score, the higher the rate.
That's correct. There is a correlation between interest rates, credit scores, loan to value on the property, how much money you're putting down on the property. So yes, there is a correlation.
And does the credit score affect, you talked about loan to value, which would mean whatever the value of the property is, how much money you can obtain in financing. Does that also affect that in some cases?
Yes, it does. There are some lenders where their guidelines or their grids, when we're figuring things out, saying, okay, if you want to put 5% down or 10% down, your credit score has to be this. But if you're putting 25% down, then your credit score only has to be this, and there could be a difference.
Okay, so that's important to know. So all these affect, if you're going to refinance or even purchase for that matter, what the savings will be, because you want your credit score to be a little higher so your rate will be lower, or at the current market, whatever that is. So that's good information to know. And I know that I mentioned in my description that your credit history also could affect your employment. So nowadays, not back in my day, but nowadays when you apply for a job, they pull your credit. And unfortunately, you could have gone through a bad time. That doesn't mean that you won't show up for work every day and work hard, but sometimes the employers look at your history and say, oh my gosh, they're not able to make their payments on time. Maybe they've had a bankruptcy. Oh, bankruptcy, we need to ask that question. And then they sometimes think, hey, desperate people do desperate things. So it's important. It's never too late to get started again. Whether, like she was saying, there's credit card companies where you can actually send in money, set up an account for $200, $300, and just charge on that and slowly build your credit, because unfortunately, most of us don't have $100,000, $300,000, $500,000 in cash to buy a home. So you do need to have a good credit history established. So let's just go back to the bankruptcy really quick. How does bankruptcy affect your application for a mortgage? Do you have to wait a certain time, maybe like you do in the foreclosure instance?
The answer is yes. Depending on the type of bankruptcy that you are in or have had, that there is a waiting period correlated to that as well. There is one bankruptcy that is a repayment plan that you've entered into, and if you have made that payment plan for 12 months the way you agreed to from the beginning, then that waiting period would have been that 12 months of showing that you paid accurately. The other two bankruptcies do require a certain waiting period. But again, the reestablishing of credit, I think, is what you mentioned, is really key. Even if you filed for a bankruptcy yesterday, you want to do whatever you can as quickly as you can to start reestablishing credit through the secured credit cards or other things.
So we have to look at things on the positive side. There's always hope for you to own your own home. No doubt, it may not be today, but it will be in your future. So don't give up on yourself. Just keep looking at positive side of things and moving forward. So again, I'm here with Deborah Reyes. I'm Michelle Fernandez. If you have any questions on how you may want to qualify, whether it be to purchase a home or to do a refinance, maybe you've had issues with your credit or you don't have any and you've been thinking about getting a house, I encourage you to message Deborah, because she's been in the business for over 38 years. So she's definitely full of knowledge, an expert in the field, and a real great resource, and she helps people out all the time, whether you use her or not. She is a mortgage broker, so she's got the ability, like we talked about yesterday, where she works with several lenders, versus if you go to a bank, you're kind of stuck with just their rules or their guidelines. As I say, those with the gold make the rules. So then you're limited to maybe what you qualify for there. So that's also a good resource, because she can kind of check a few different places. So I will put her link in the comments below of where you can reach her. You can always message me as well, and I'll be happy to forward the message on to her. So if this was beneficial to you, please be sure to share this video, as well as get the notifications for all the live videos that I do, so you don't miss it. And tomorrow we'll be here for the third part of our series, where we're going to talk about assets and collateral. So I hope you have a great day, and we will see you tomorrow.